Welcome to the All About Alts podcast, where we explore the world of alternative investing to help you find financial independence. Join our host, NuView Trust's president, Jason DeBono, as he covers a variety of topics with different guest speakers to discuss tax and alternative investing strategies. It is never too late to start taking control of your financial future, and we are so excited for you to be joining us for this opportunity to hear from some of the best in the business.
Welcome to the All About Alts podcast. I am Jason DeBono. I am your host today, and I am joined by Shannon Robnett, a total wealth of wisdom. But Shannon Robnett runs Shannon Robnett Industries, second generation developer, builder, fourth generation realtor. So I got a feeling we're going to hear a lot about the real estate world today. So Shannon, welcome. Thanks for being here.
Thanks, Jason. Happy to be here.
Cool. Well, let's dig right in and let's talk a little bit about this second generation, developer builder. Take us all the way back, kind of walk us through and tell us a little bit about kind of what that means and where you, from a personal standpoint, sit in that builder developer side.
You know, I grew up in a house that every Saturday and Sunday was spent cleaning job sites and putting in sprinklers and, laying sod. And so I wasn't real thrilled about that. And when I graduated high school, I was going to go into computer information systems. So I went to college and I was watching my younger brother build houses. During that same duration, I was waiting tables in a coffee shop, trying to pay my car insurance, make about $45,000 in, was that 95, 94. And I realized very quickly that computer information systems wasn't going to do that for me. And so I went back and I started building residential houses and transitioned into commercial real estate, grew a company that, we did a lot of things from city halls to police stations, medical facilities, schools, gymnasiums, all that kind of stuff. And every time I got done with a job, I saw that my paycheck stopped. And I was watching the people that I built for continue to own that. I watched my father retire at 50 on cash flow. I began to look at that, and I built my own, my first building in 2001. And here it is 21 years later, and I still have, two of the original 6 tenants, and they've continued to pay the rent on time. And, one of the businesses even sold 3 times, but that tenant, it's a gelato ice cream manufacturing facility, and you can't really just move an 18 by 24 walk-in freezer. So, I began to go that route, and I began to partner with some people and do, a deal with a guy. And pretty soon the plans that were on my desk, the projects that we were taking down was just a little bit too big for us. So we started raising capital and syndicating, and that's just kind of opened up a whole nother realm to us. And we currently have about 400 units of apartments under construction and multiple industrial projects. So that's kind of how I got here. And it was just kind of, a natural transition, taking one step and solving that problem, and then taking the next step and then solving that problem.
Well, it's great that you had that realization, early on that, you get into the career part of it, and sometimes it's hard to make that transition. We talk to a lot of people, and that's always one of the questions we do spend a lot of time on is how did you get out of X, right, and into real estate? Right. But you've really been dabbling in it almost your whole life, but certainly early on. So you're building homes, you're building, buildings, you're building multifamily, you're building office, you're building industrial. Is everything that you're doing ground up development? Is that kind of typically your approach, or are you doing some other stuff as well?
We do a multitude of things, but if a deal pencils, right? Sure. The multifamily ground up development, that's a 36 to 48 month process, right? There's no cash flow during that time. There's tremendous appreciation, but that doesn't fit every investor. So we looked at that and we said, okay, well, we've got a lot of knowledge in areas like multifamily. I built a lot of industrial. And so we start looking at deals that pencil that are for sale. And we're in, 5 different markets across the nation. And we see where you can still add value. You can still manage something better. You can still improve something. You can still do those things, but doing it in a way that works for your investors become kind of the core of what we do, is looking at it and making sure that we're fulfilling the needs that they have in what we're pulling across the table.
Well, and I'm sure your, real estate development background makes you a better buyer. even of stuff that's already built. I assume you can go in and see where corners were cut or see where, there are some value add opportunities, true value add opportunities, and, from a development standpoint. So that's a nice lens to be looking through.
It's also made me a stingier buyer too, because I always look at it and go, man, I could build it for cheaper than this. But that really speaks to the testament of what the real value add is. The value is the tenants, right? The value is the relationship that you have with them, and how long are they in there for? What's your turnover rate? What's your flip cost? What are you dealing with that? And so you really get an appreciation for that balance between vacancy and occupancy and cost and all of those kinds of things, to really understand, is this something we need to add value to? Will it pay off if we go in and spend $20,000 a unit or reface the building? So it definitely has its pros and cons. But at the end of the day, it's been a huge value to me, because that's obviously the hardest part, is finding the property, the project, and doing the ground up development from the beginning.
Yeah, well, and I love how you kind of, highlighted something a lot of people don't think about on the development side is, it's a lot of work and effort to develop, and it can be a great strategy and structure, but it isn't for everybody. There is quite a tail, on a development deal in terms of getting property, getting it, to be able to be zoned, getting plans approved, getting all the necessary entitlements, and then obviously you've got bricks and sticks, and all of that comes before you actually earn a dollar. And
Right.
so, yeah, for some people, that's a tough place to invest.
Yeah. But there's balances to that too, because the bank wants to ensure that the project's successful. So one of the things that we always figure into our development budget is the interest carry, right? And what
Yeah.
that is going to take, and how long the project's going to go, and making sure that you're over compensating for that.
Yeah.
And then the other thing that we're doing is we're always developing, usually to a 7.5 or an 8 cap, which in the market that we just exited, where we had stuff selling at a 3 cap on the real estate side, it made for some large profit margins, but there's also a substantially large protection to that development side, that the banks, the last thing they want back is a half finished project.
Right. Right. Well, let's talk a little bit about, the market today, and we're going to talk a little bit more from an investment, strategy here in just a bit. But I do want to talk a little bit about, what impact, you mentioned kind of your underwriting guidelines, leaving certainly some margin there. You hope for the best, but it sounds like you're penciling for the worst. What are you seeing from a cost standpoint? Have In a development project, we've seen lumber go through the roof. It's kind of made a soft landing back somewhere in the moderately realistic world. But
Right.
how are you managing that? What are you seeing? What are some of the things that are posing some challenges, and what's creating some opportunities?
Well, the reality is, supply constraint has been our biggest issue to overcome.
Yeah.
When we do a large scale project like this, the day we start is the day we sign 90% of the contracts. So we're fixed in on our cost. It may take 3 years to get there, but the plumber's locked in on his contract from the beginning. And so we've got some things that we can control. We can't control concrete pricing. We can't control lumber pricing. But this is where speed makes sense, right? The faster you can go, the less interest you burn.
Yeah.
And there's ways to mitigate that. And it's not always cheapest bid that wins, because you're talking about timelines to go with that. But we've seen a lot of things change. I mean, we've seen prices on commodities come down, but services go back up. With inflation happening, workers need to be paid more to maintain the same standard of living. So we're constantly dealing with stuff like that, but we've mitigated as much of that as possible with our contracts early on, and then just making sure that we're using reputable contractors, things like that, so that we can do everything we can to make sure that we've taken all of the bugs that could happen out of the process. And then you're right, with your underwriting, you can make this look like a 26% return, or you can make it look like a very realistic 16% return, with lots of opportunity for life to happen, interest rates to rise, cap rates to change, supply chain issues to happen, and rushes need to be put on things. And so I think that that's back to my 2 generations, my 28 years in the business, where I can really relate to that and go, man, I'd really like to get you a 26% return. And we do that quite often. but my underwriting shows that we're aiming for that 15, 16% with an opportunity to impress you instead of shooting for 26 and coming in at 24 and a half and having everybody try and hang you from the street post.
Well, and it's interesting. We talked a few episodes back, about expectations, and it is really hard. The problem that good quality, syndicators and developers or whatever the project is that you do one project and return 25%. You just set a floor that everyone assumes every deal always will
Yeah.
do
Right.
25%.
Right.
So I think this market getting a little bit sideways. Not all areas of the market will be affected, but it is a good reality check for a lot of investors.
Yeah.
I remember the days, and I still subscribe to the philosophy of, if you get me double digits, I'm elated.
Right.
I'd love to
Right.
make 25% on every deal, but if I
Right.
just shoot for 10,
Yeah.
I'm going to have
Yeah.
a really healthy portfolio in the long run.
Well, and the other thing that a lot of people don't look at is, they look strictly at the return, right? And they
Yeah.
go, I'm getting a 25% return. You got to factor in, how are you getting that return? Are you in a tax advantage situation? Or are you taking that 25%, cutting off, 35 or 40% for
Yep.
Uncle Sam, and then trying to reinvest, right? And so there's a lot of that where we pay a lot of attention, probably more attention to how the deal is going to get done uh, than the underwriting, because the reality is, if I can add 15% benefit from a tax situation to
Mhm.
your equation, then the reality is you're going to wind up with a 10% plus a 15% savings. I don't know how you calculate that, Jason, but to me, that's 25%, right?
Right.
And if you're paying attention to those kinds of things, then you can make sure that you're really positioning yourself to win in the biggest way possible in multiple categories across what is investing. And a lot of people don't focus on that.
Yeah, well, you obviously, on the tax advantage side, you're speaking my language, but
Right.
I love that you guys look into that. It's, I think there's a big gap, and people try to make money, which is great. Everybody should try to do that, but the wealthy don't try to make money, right?
Right.
The wealthy try to
Right.
build wealth, and you
Absolutely.
build wealth on both sides of the equation. And I'm totally with you. If I can make 15% tax free, it's better than 20% taxable. I'm going
Absolutely.
to come way ahead. So now, if I can get my 20 and keep it tax free, right now, we're really
Right.
starting to have our
Right.
cake and eat it too.
But the reality is, you talk about the compounding effect, and Warren Buffett calls it the eighth wonder of the world. And if you can take that, that additional 5% for 10 years and continue to reinvest that, you're not 50% ahead, because you went up 5% the first year and reinvested that amount. And then you went up 5% the
Um,
second year. You've continued to reinvest that. You'll find yourself, over 125% ahead of where you would have been if you'd have paid the taxes on it, because of the compounding effect of just paying attention to your taxes.
Yeah, I share this a lot, and at the risk of beating a dead horse, if you take a dollar and you double it every year for 20 years, you'll end up with the gap between doing that in a tax advantaged account versus doing it in a taxable account. At a 25% tax rate, the gap is nearly $1 million. So
Right,
that
on a dollar.
means you get $1 million
Yeah,
more for the
yeah,
same investment, same time
yeah.
commitment, same risk profile.
Right.
That's building wealth.
And the reality is, how many people don't pay attention to that? Don't
Yep.
They think they don't care about that. I'm not gonna go to this tax seminar. I'm not gonna learn about this stuff.
Yep.
I'm not gonna buy into these gurus or whatever. And yet it's $1 million. It's not a small amount, and
Right.
nobody's investing a dollar.
Yep.
Nobody's doing that. They're investing much more than that, but they're not investing the time to truly understand it and multiply that to really make a difference in their life.
Yeah, well, you nailed it. I've had people that have said, "Oh, you're going to charge me a couple $100, to custody this account. I'll just do it another way." And I'm thinking, how much tax are you going to
Yeah.
pay?
Yeah.
You're probably going to pay 10 or 20 grand in tax, and
Yeah.
you won't pay a couple $100 to do this in a
Right.
tax-free arrangement. But
Right. Yeah.
those are the people that they'll make money.
Yeah.
It's just
Sure.
they'll miss the mark on building wealth. when it's
Well,
all
and that's
said
the
and done.
difference between leading a horse to water, realizing the horse is stupid, and then beating the horse. That's the
Right.
beating the dead horse. And you're right. I mean, there's some people out there that it's mind-boggling how they choose to do it. There are harder ways, but why did you have to pick the hardest?
Yeah. Well, the beauty of what we do is we continue to try to educate and hopefully people along the way realize that a small investment of time and knowledge and understanding and maybe even a monetary investment will yield them the best returns they've ever gotten. And it's not the return that matters; it's actually keeping it all when it's all
Correct.
said and done. So.
Absolutely right.
Well, I want to dig in a little bit deeper after our little quirky question of the day segment, which we're going to step over here in just a second. But I do want to dig deeper a little bit into kind of investment thesis. What are you seeing in the market? What are the asset classes? So we'll get to that, but we are going to hop over to our quirky questions of the day. So Maggie, our producer, is coming by with the envelopes. Remember, if you have, thank you. If you do have any quirky questions that you guys want to add to the list, you can email Maggie at NuViewTrust.com. So Maggie with a Y, NuView with a U. All right, Shannon, you ready?
I'm ready.
All right. What is something that you just recently realized that you are embarrassed by that you didn't realize earlier?
Probably recently in the last little bit, I think that it's one of those things that the more you know, the more you realize you don't know. And I've been looking at some different things, and I've always wanted a sports car, but I've always told myself you have to pay for that. You're gonna, and you can't write it off and all those things. And then I realized there's this funny little app called Turo. And so I can now take and buy my sports car, put it on the Turo app, write the whole thing off in year one, take that for a tax advantage, and let somebody else drive it a couple of days a month. And I feel really dumb because Turo's been around for 3 years.
I love that. I guess color me dumb as well because I never thought about that. But you just gave me an idea. I appreciate that,
Well, and the
and a
worst
good
part
one.
is I do it with airplanes already. I have a flight school for that reason. And we write off airplanes, and I never thought to do it with the sports car I wanted.
How cool! I like it. Question number 2, real straightforward one: is water wet?
Yes.
Okay. So some of these questions you do have to kind of think through
Yeah.
a little bit.
I was wondering where the trick was in that. I mean, last time I spilled it on myself, it was wet. It was wet this morning in the shower.
There you go. Water is wet. All right. Question number 3: if animals could talk, which one would be the rudest?
I would think probably the rhinoceros. I mean,
Okay.
you know, just they kind of strike me as a rude animal. Not that I've met many rhinoceroses here. Is it rhinoceroses? Is it rhinoceri? I don't know. What happens when you
I'm
get more
going
than one?
rhinos. I'm going rhinos. So, well, there's no doubt it's amazing how you can look at an animal and it just puts that vibe off. I'm with you.
Yeah.
Although the other one to that is I think it's got to be cats too. There's something about cats. They're just naturally
They're
rude.
aloof. They're smug. Yeah.
Yeah.
Yeah. I was also thinking like geese. Because they
Yeah.
attack you. But then, is that the geese of New York? I mean, I don't know. So.
Well, there's plenty of animals to choose from, but we've got it on the books as the rhinoceros. So good choice, Shannon. Well, thank you for participating. Thank you to our listeners for keep feeding us the questions. Every time I pull an envelope, I always smirk a little bit as I'm pulling it out and starting to see some of these questions come through. So it is fun for me, and thank you for participating. Let's get back to it, and let's dig in on this kind of real estate market today. You've got 28 years of watching this through your own lens and of an investment world. What are you seeing today? Let's start with challenges. What are you seeing in your world today? Maybe outside of the obvious, like interest rates, that sort of thing. But what are you kind of seeing as some of those challenges that are presenting themselves today?
Well, Jason, the reality is this is the market. These are the interest rates that I've worked with most of my career, right? So we had a unicorn situation where we had these beautiful interest rates, and if you weren't locking them in at the longest term you could possibly get, I think you kind of are realizing now that that wasn't a great move.
Yeah.
But the reality is, this is what we're used to. This is what I'm used to. I'm used to 6, 7% on the commercial side. I'm used to 35 to 40% loan to value, loan to cost. I've always kind of underwritten this way, and I've always played this way. But some of the challenges that we're really seeing is sellers are still looking at 2022 pricing,
Yeah.
and we're firmly into 2023 and trying to explain the correlation between interest rate and price gets to be a little mind numbing at times, because the reality is they're looking at price. When they bought it, they looked at cash flow, but their whole position is switched. Now they're looking at price only because they're exiting it, and they're not taking that into consideration as far as what the next guy has to do to achieve cash flow, which is why we buy real estate, right? It's why we focus on that asset, is because somebody else is not only paying the tab, but there's cash flow involved with it as well.
Yeah, sellers, investors, sellers, all still have, a very hard time letting go of maybe some of the bull runs that we saw.
Yeah.
And not to say there's not great value and great deals and great return opportunity in real estate, but some of that stuff does have to norm out a little bit, and rising costs should naturally bring down some of the costs
Yeah.
of sellers. But we hear that a lot is, it's finding the right deals, getting a seller to not only be willing to sell, but also to be open and understanding of the market conditions for the new buyer. So,
Right.
what are you, obviously challenges are always there. And I love what you said about going back. We have such short-term memories, right? We all think that interest rates are 2% and 4% is normal. But I mean, I remember the first house that I bought, I paid 7.5% interest, and I was
Yeah.
tickled.
They
I
used to say, if it's
thought it was
under 8,
great.
don't hesitate,
Yeah.
and that kind of rhymes with, if the glove doesn't fit, you must have quit, right? But I mean, and you might be too young to remember that one, but
Oh,
but
that was an OJ
that was OJ. Yeah.
OJ trial. I
Yeah.
remember that vividly.
Yeah. But the funny thing is real estate is cyclical. I think all assets are cyclical. Gold and silver fluctuates. Bitcoin's been up and down. The stock market's always in flux for some reason, and there's always those guys that buy at the top of whatever market, not really understanding their asset class, not understanding why it's there. And I think that's a little bit easier to get caught up in the stock market, because it really is more of a supply and demand and FOMO kind of an environment, where real estate has some intricacies, and gold and silver has some reasons why it does what it does. But a lot of that is understanding why you're doing it.
Yeah.
And understanding what your value proposition is to yourself to get there. And if you're really sticking to an investment thesis that makes sense, that makes it plausible for you to understand why you're doing every single deal. People that bought real estate in 2021 may have been really close to the top of the market. But if they did the right things with their deal, and they put permanent financing on it, and they've got cash flow, what's happening now doesn't necessarily affect them.
Right.
Maybe they can't exit the deal right now for the profit margins that they wanted. And maybe they're having to look, instead of a 4-year window, they're looking at a 10-year window. But then again, what's wrong with that? If you're doing what the investment thesis is, it's a lot easier to understand how that's replicatable and how you can stay safe.
Yeah. Well, it's something that you bring up a really good point, is if you underwrite it right, the market conditions were what the market conditions were when you bought it. And if they're
Right.
right, they'll still be good market conditions. Now, whether the market changes and maybe causes you to have to, put a little bit longer, hold time. But I really like, kind of thinking it through from the deal has to fit. And if you put the benchmarks in place, you can kind of sidestep some of these challenges that we're seeing today. And I think what we all know, what's creating any sort of potential issue or risk for people holding property today is that they just weren't prepared to ever hold it.
Right.
They thought they'd get in, they thought they'd get out, which is fine. It's a great strategy, but you always have to kind of look and say, what if? And I think there's a lot
Right.
of underwriting that never really had that what if line
Right.
into it.
Right.
So,
And when you're going after the appreciation play, there's nothing wrong with that, but you have to understand that you really need multiple exits. And we see this
Right.
a lot in the stock market because, you're buying a stock for appreciation, unless you're getting a dividend stock or playing with bonds or things like that. You're really looking at buying it at price X and you're selling at X plus 10, right? And that's the whole thesis behind that. And that works sometimes, but that's one of the beautiful things about being involved in real estate is yes, it does appreciate, but it appreciates because the rent goes up. It
Yep.
appreciates because the cash flows goes up. So there's multiple things that can take care of your asset before it has to become you taking care of your asset.
Yeah, we love real estate for that very reason, and there is nothing wrong with the stock market. It's great. I think the hardest part I see in the stock market is it's really hard to be fundamentally sound in the market. I
Right.
mean, we're at a point now where we have the highest number of zombie companies.
Right.
Companies that still don't have profit, and I'm thinking to
Um,
myself, how can this company with no profit? Be worth way more as not just the stock price, but the total market value is worth more than Walmart, who
Yeah.
has one of the greatest businesses that's really never been under any threat. It's just
Right.
about recession proof. They turn 15 to 25% profit margins every year. And
Yep.
you're valuing companies on this new and unique product. They haven't even sold enough to turn a profit,
Right.
you know? And you look at like DocuSign. I mean, here's a company that I completely understand a lot of the hype through COVID, but they had the greatest opportunity to accelerate their number of users faster than ever. And
Right.
they still can't turn a profit. And I'm thinking to myself, well, if they can't turn a profit when all eyes were on them for 2 full years, how are they going
Right.
to turn a profit in 5 years, 7 years, 10
Yeah.
years? It just baffles me.
Well, and Zoom did the same thing, right?
Yep.
And again, you're getting into that. Well, I'm selling because I made 10% on mine, and it's time to sell. And you're buying because you want to make 10% also. There's no underlying
Right.
fundamental because the bottom line says that the P&E ratio is in the toilet, and there's no cash flow, and unless they continue to get injections of capital and cash and things like that, they're going to continue to have problems. So what are they going to do? Continue to you know, add more stock to the pool and do those things that devalue the other investors. And at the end of the day, you're holding a piece of paper or something in your Charles Schwab account, you know,
Yep.
then there's no value to that.
No, and when you come back to real estate, the fundamental price of the asset fluctuating, while it's important, it pales in comparison to cash flow,
Absolutely.
right? So you
Absolutely.
can still make money while the property may be losing some value in the overall market, whether it's for interest rates or cap rates, it doesn't matter. And still end up making a nice 10, 15% return year over year over year on the cash flow from that property.
Yeah.
Um,
Well, and what would you rather have a steady 10 or 15% a year, or, throw a couple $100 at DocuSign and hope that 10 years from now that thing explodes and you're able to get money back. In the meantime, it's a total
yeah.
crapshoot.
Yeah, well, we're obviously on the real estate side of the equation, but
Yeah.
I do think for so many people, our goal with this podcast really is just to help people, hear some things that are a little bit different. And I'd imagine there's people listening today that have a stock portfolio, right, of stock sponsored mutual
Right.
funds. They probably don't even know what those stocks are, what they do, they just either bought them because the Yahoo Finance page said it, or Jim
Right.
Cramer yelled "booyah," and
Right.
threw a cow under his leg or something. But they're not buying anything for the sake of this is good, because they're buying it because it's a little of the greater fool theory.
Right. No, and I think I saw that episode where he tossed the cow, but it is because you're not uh, you're betting on so many external factors that have nothing to do with you, that you have zero control over. You don't even know what markets you're in. You can't check the fundamentals of how is that business plan being executed like you can with real estate. And you have it especially with multifamily, you have the basic human need at your fingertips that
Yep.
everybody will always need housing and they will always need Walmart, you know?
Yeah, well, we're certainly on the same page on that, and I love looking and talking real estate, and because it continues to remind everybody, self included, that man, the right real estate in any market in any conditions can be successful. So let's talk a little bit about today's market, right? What are you eyeballing, Shannon? What do you think is penciling out a little bit nicer maybe than other asset classes looking forward over the next 3 to 5 years?
Well, we've I've done a lot of industrial in my life, and the thing that I really like about industrial, especially in inflationary markets, property taxes are going up. I think, insurance, everybody's clamoring that insurance is going up 30 to 40% across the
Mhm.
board. Even water delivery in our area is taking, record jumps because of the infrastructure that's needed to be put in. But when you're dealing with an industrial asset class, that is a triple net lease. And the beauty of the triple net lease is all of those expenses are passed through to the tenant. So, if your rent is $1.20, you're going to have a triple net of probably 25, 26 cents on that. So the tenant is paying both of those fees to you.
Yeah.
And at the end of the year, you reconcile that. You look at it, you go, well, it was a 28 cent a month triple net. So I got to bill you the other 2 cents, and we're raising our mark going forward to 29. So you can really look at it and go, this is like super easy for me to look at and go, my rent is my cash flow, right? And so now I just have to protect against keeping those tenants, but you're also dealing with tenants that have multi-year leases, right? And you're dealing with business people. When a person looks at it and they go, well, my rent just went up $50, I can move down the street, it's only the weekend, let's do it. Or you're looking at, a guy that's got a fencing company or a
Right.
tech company, or manufacturing of some sort. They've got to stop production, they've got to take their employees, they've got to move all of that stuff. It's very expensive, so tenants tend to be very, very sticky.
Yep.
uh, and you're dealing with a product that is really recession resistant, because more small businesses are started in the times of recession than anywhere else in history, and it's been proven over and over again. So being in that industrial space for us has been something that we've been in a lot, but it's really starting to shine. The other funny thing about industrial is it tends to trade at a little higher cap rate than multifamily, because multifamilies everybody's darling child. You get, Beardy Brandon talking about, you house hack into this, and then you do this, and everybody wants to know, fourplex, then, 16plex, then whatever. Where industrial tends to be maybe, a small industrial is maybe a $5 million deal. That puts it out of a little, some people's
Yeah.
reach. But when you get there, it's more of an institutional, relatable asset that has those kinds of returns in it.
Well, industrial, it lacks the sexiness, right? Of,
It
that
does.
everybody wants. Well, you got a fencing company that's storing all their fencing, in the yard, and it's a big open warehouse. And why do I want to own that? But for all the reasons that you mentioned, these people are there. They're good quality businesses. They're likely not going anywhere anytime soon. They pay their rent, and I'm really glad that we hit on the topic of triple net, because that's an area that very few people are aware of,
Right.
of how that works. But, being in a triple net and knowing that whatever you collect is yours,
Yep.
and you're not collecting it and holding a little bit back to pay insurance, which when it goes up, it comes out of your pocket, or when
Right.
taxes go up. It's a beautiful thing, and certainly a pretty cool asset class that, we see it a lot, in our world, but I still think it's a very small amount. Everybody, they just want doors,
Yep.
which is one of my
Yep.
favorite things to hear people promote, is how many doors they're invested in.
Yeah.
I think it's probably the number, it's like our weight. It's the
Right.
number that we all figured out how to, manipulate in some weird way. But
Yeah.
industrial really is opportunistic. So, let's talk about industrial, and take it, maybe continuing down that road. So, you mentioned there's an entry point of industrial that's a little bit higher. Talk to us a little bit about why that is. Why is it, a little harder to kind of break that barrier? And then from a cost standpoint, what drives the cost, and what is the underlying fundamentals of the pricing of
Yeah.
industrial?
Well, when you think about a single family home, that's where a lot of real estate investors start, is a single
Mhm.
family home. You're 1,300 square feet. I would think a small industrial building's 20,000 feet. So if you just look at the cost impact for size, that has some barriers. And really, when you start to think about it, when you're talking about multifamily, you've got a lot of turnover. There's, an average tenant stays in multifamily about 18 months, right? So, you're talking about a lot of turnover. People build their businesses in a certain area. They've got to they've got an address. I know some people still get mail, right? They've got a location that
Yeah.
customers come to. They've got an expectation. They've got all of these things, and so you're building something that is pretty. Once you move a tenant in, I mean, we've had tenants in our buildings for 22, 24 years, right? And they've just literally sat there and paid for that thing. And it's very rare that you have someone in a rental home or an apartment that stays that kind of
Yeah.
duration. And the other thing is when you look at that, industrial, the other thing that life insurance companies love to be the lenders. They love to pool the money and be the lenders on the industrial. So you're dealing with fixed interest rates. We just did an assumption on a project in Houston where we've got a 30-year AM and a 10-year fixed at 4% that we assumed from the guy before us, right?
Wow.
So we've got 10 years left on this, and getting that kind of fixed rate in multifamily is very difficult, And so there's a lot of those things that just kind of tend to play toward the more institutional buyer. And so it leaves a lot of people looking through the glass going, I would love to be involved in that, but I can't buy 100,000 square foot building. And how do I manage that? And how do I deal with that? And that's where, we've kind of stepped in as syndicators and bridged that gap.
Yeah, well, the stickiness of these, tenants is huge, and we really haven't seen. We've been in an environment where everything's been shooting up like a rocket. In the
Right.
multifamily and even on the residential side in a lot of markets. And so I think by virtue it makes some of those tenants a little more sticky, harder for them to move. But you mentioned this earlier. For $50, they'll move over the weekend. And all it takes is one apartment, to see a slight drop in vacancy, to make a slight drop in pricing, and now it's a race to the bottom,
Yeah.
because everyone's moving across the street to save $50. Well, how do they get them back? They got to drop the rent 100 and get them to move back across the street a year later. So, we haven't really seen that play out yet. I know some markets are feeling that, but we're starting to see and hear a little bit of that occupancy rates are getting a little bit lower. Rent increases, if at all, aren't happening in some
Right.
markets. You're seeing rent decreases. So
Yeah.
watch that closely over time, and we'll kind of see how that continues to play out.
Well, and the other thing is, when you're dealing with industrial, it's very normal to sign a 5 or a 10-year lease. And even if the market as a whole is going down, the tenant is obligated to take the 3 to 5% increase that you guys have negotiated. So while it's definitely not as sexy as multifamily, and it doesn't have the opportunity to have the spikes that multifamily does, it also is very protected on the downside. It's kind of like, the story of the turtle and the hare. This is the turtle, but it's always churning and it's always growing and it's always increasing.
Yeah, no, great analogy, and certainly something to be mindful of. It's and in the investment world, especially with tax advantaged accounts, it is a long race. It is a
Yeah.
marathon, not a sprint. And yeah, that tortoise and the hare example is so spot on. I may borrow that from time to time if that's okay.
Yeah. I didn't make it up.
I suppose you borrowed it yourself.
Yeah.
Fair enough. Well, let's take one kind of sidestep, and look a little out. From an interest rate standpoint, you mentioned that you're used to this, right? 6-7% interest rates is a normal environment. Totally anecdotal opinion on where are interest rates headed. Do you see a time where interest rates come back down in a meaningful way? What's your crystal ball telling you?
We're kind of positioning ourselves that we may see one more rate hike before the end of the year. If you look historically, every time there's an election year, interest rates drop. To what degree, we don't know. Whoever's in office wants to look as good as possible for homeowners. But I think that we're kind of back at our normal. We may see 6% again, but I don't think that's going to be in the foreseeable future. We've got inflation that's pushing hard on one side. They just solved the debt ceiling problem, which means that the government's going to be printing a lot more money, which means you're going to see prices continue to inflate. And so you're going to see that struggle of the economy still doing well. They're trying to hold it back. You can't push interest rates much more
Mhm.
because then that puts the banks in the position where now all of a sudden they're seeing decreased values because interest rates have gone up and they got notes that they'll have to call. And so I think that we're kind of at a place right now that there has to be there's likely to be some stability for at least the next 18 months at where we're at, or just slightly higher. So we've got a spot here where deals are still going to get done.
Yep.
Things are still happening. There's a lot of people that bought in 19, but there's a lot of people that bought in 79. There's a lot of people that bought in 84. Those people are now coming to market. I mean, there's always something for sale, and it's just a matter of positioning yourself in a position to take advantage of that and understand that you can make a deal happen. My dad was building and selling houses at 17% interest in the Carter era, right? And there were deals happening at that point. You just have to be in a position where you're not expecting something that you can't deliver, because that's when disappointment comes in, and that's where bad things happen to good people.
Yeah, well, interest rates are they're always going to be there, and they're always going to be a line item, or variable in the equation. I think the best advice that I have ever gotten on interest rates is, if you buy today, if you don't buy, what's your cost, right, to
Right.
wait?
Right.
If you do buy and interest rates go down, which is what you can always refinance into it, and so
Right.
you've got people look at interest rates as being this kind of deal killer, and the guy that gave me that guidance said it shouldn't be a deal killer at all. It's just a
No.
factor. Right?
You buy the asset, date the rate. You know what I mean? Because
Yeah.
if it goes down, you can take advantage of it. But getting long-term financing, I think, is something that a lot of people have lost sight of, because things were, if you've got 5% and you see it going to 3, gosh, you're going to refi. And then you're thinking about it. Well, why would I lock in at 3? Because maybe it's going to go lower. But the
Yeah.
reality is, if you've got a long window, you've got a lot of runway, and you can cover a lot of mistakes. The other thing too to remember, Jason, is we've all, for the last 50 years, we've seen inflation of at least 3%. So if you're looking at an 8% interest rate, that's going to be fixed. The amount you borrowed is fixed. So every year that we continue to inflate, and your rent is going up or your income is going up by that 3% margin, you're paying back today's debt with tomorrow's dollars. So every year you hold that asset, it will get cheaper. It will take
Yeah.
less of your disposable income, because this asset is fixed in its price and it's fixed in its rate. And so you're able to offset a lot of that in arbitrage in its own way, because we're not going to stop inflation anytime soon. And we've been, for the last 30, 40 years before 2019, we were always sitting at 2.5 to 3% inflation.
Yeah.
So pulling all that back and going, gosh, I'm now paying back with cheaper dollars, makes a lot of sense.
I love that point. I've not heard anyone articulate that well, and it's so true. I, dollars go up, but fixed assets and fixed prices get paid. They
Yeah,
become a little bit cheaper day by day. Great
exactly.
commentary. Well, let's get you onto the hot seat for just a minute, Shannon, for a quick lightning round. I've got 3 questions here that are critical. We'll drive through them. Let's start with question number 1. What's the best investment you've ever made?
The investment in myself. Honestly, you can't continue. You can't continue to do anything uh, with yesterday's knowledge. You have to continue to spend time and effort on yourself, because it's only through that you really realize that you can go to the next level, that you can expand your portfolio by expanding your mind. And I think a lot of people overlook that.
I love it. Question number 2. From an investment standpoint or philosophy, if you had to pick one asset class for the rest of your life, what asset class you invested into?
Probably industrial,
Okay.
just because it's one of the most stable real estate classes out there.
Okay. Question number 3. Now, this is a pivot, because I've decided, and it's curiosity getting the best of me. So I'm going back to your sports car, and we're gonna do this one on the go, and I'll save this for another time. But question number 3: what kind of sports car did you get?
It's a Ferrari Spider,
Oh, so
488.
and you're in Boise, so
Yeah,
I just need to come to Boise and get it
that's
on
right.
Turo.
That's right. That's right.
I
Exactly.
love it. And full
Exactly.
depreciation, 100%, completely write off your taxes in year 1.
Yeah, exactly.
Unbelievable.
Because it's a business tool,
That's
right?
right.
It's
And
just
it's
like I bought a
producing.
computer or a copier, or
Yep.
you know, I just like to see the IRS agent's face when he looks at my list of depreciated assets, and copier, printer, shovel, Ferrari.
Well, and he or she is perfectly capable of going on a Turo and renting it themselves.
Exactly.
If they don't believe or understand how the business side of it works. So, of all the things, that you shared, that one is still sticking with me because it's absolutely brilliant. So, thank you for sharing that. Shannon, thank you so much for being here. Absolutely loved, hearing some of your wisdom and thoughts and ideas and strategies on the real estate side and on the tax side. So I want to start by saying thank you for that.
Yep.
And then, we close every show out with the Learn Before You Burn segment. This is the opportunity for you to share how you've, what experience that you've gotten with a good lesson, but that experience that may have been painful. You learned it the hard way. And so how can we help our listeners maybe get the lesson that came with it, but not have to go through the same experience as you? So we'll bring it to a close. Shannon, what is your Learn Before You Burn guidance for our listeners?
2008 was that for a lot of us. And I think that diversity is important. I think that having some cash on hand, we heard everybody in 2021 saying cash is trash, but the reality is, having adequate reserves and having a thesis that was not an all in on appreciation was probably the biggest life lesson for me, and is really what's helped us to build the portfolio that we have now, because we have different asset classes in different cities, in different categories, in different stages, so that we've always got something that is holding down the fort, that's paying the bills, that's taking care of things while we do some of the other things that may be perceived as more risky or things like that. So we've really looked at diversifying, though 95% of what we do is still just in real estate.
Wonderful advice. Diversity always wins, and real estate diversity is incredible. So,
Yeah.
Shannon, great job today. Thank you so much for being here. For those of you that are not subscribed, be sure to hit that like and subscribe button. If you'd be kind enough as well to go on and give us a rating, we'd love a 5-star and help the community of folks out there that aren't listening to the show maybe get some exposure and get some access to it. So we look forward to continuing to provide education on both the investing side as well as the tax advantaged strategy to just simply keep more of what you earn. So, Shannon, thanks for being on the All About Alts podcast. We appreciate it. Everyone else, take care.
Thanks, Jason.
Thanks, guys.
Thank you so much for listening. We hope the information within this podcast has given you the tools that you need to find your way to financial independence. We would love to partner with you on this journey. Text ALTS, that's ALTS, to 407-708-1853 to learn more about how to get started today. Don't forget to follow us to make sure you don't miss a second of content, and we'll see you next week.